There are all kinds of derivatives in markets today. We're going to talk about what a derivative is and give a basic explanation of several types of derivatives. A derivative is a financial contract whose value is based on an underlying asset. The underlying asset could be an individual security such as a stock, a benchmark such as an index, or a group of assets such as a collection of securitized debts. The key word to remember when discussing derivatives is contract. Derivatives are contracts formed between two or more parties. The parties agree to the rights and obligations contained within the contracts. Now, there are many different types of derivatives. Some are standardized and can trade on major exchanges such as options and futures. Some are individually negotiated between the parties involved in the contract. Forward contracts are an example of individually negotiated derivatives. The most common types of derivatives are options, futures, forward contracts, and swaps. An option is a contract between two parties to buy or sell an underlying asset on or before a future date at a predetermined price. The buyer of an option contract has the right to exercise their agreement. The seller of an option contract has an obligation to fulfill the rights of the option buyer. A futures contract is similar to an option contract in many ways. The parties to the contract agree to exchange an underlying asset at a set price on a future date. A key difference in a futures contract, however, is that both parties are obligated to meet their exchange agreement. A forward contract is similar to a futures contract, but it's individually negotiated between the parties involved. Because a forward contract doesn't trade on an exchange, it has more exposure to risk of default than a futures contract does. A swap is an agreement to exchange cash flows. There are all kinds of different types of swaps, and we can't go into them all in this video, but understand that a swap is usually an exchange between a fixed return cash flow, such as a government bond, and a floating rate cash flow, such as a prime plus rate. Derivatives are commonly used as hedging instruments or as speculative instruments. They can be used by everyone from the long-term fundamental investor to the short-term speculator. The math behind derivative valuation can be complex, and like all financial instruments, there are risks involved. When you're learning about or trying to understand derivatives, focus first on the rights and obligations spelled out by the contract. This can help you understand how a derivative is valued and help you determine whether it is an instrument that's suitable for your portfolio.